Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 174. On today's episode, Ashley Marx returns and helps us to connect the dots between real estate, entrepreneurship, and financial independence. We break down why the market feels neutral, even with higher rates, how seller concessions can lower your true monthly cost, and why Zillow is not your appraiser. We also discuss Ashley's first step into stock investing, when to buy, when to sell, talk systems, mentoring, and kind of create this whole holistic view of your financial picture. As always, get your mind right and let's get to work.
You dropped this.
Welcome back, Ashley. Good to have you here again.
Thanks for having me.
This is our third episode. So we've talked about real estate, we've talked about entrepreneurship, we've talked about financial independence. And I think today we will bring all those back together.
Sounds good to me.
So a little bit later, some time has passed. And so you and I were talking, throughout our conversations about just how the real estate market has changed, things that you're seeing that are a little bit different, even though interest rates at the time of this recording are still, what do you want to say, elevated? Would that be the right word?
I would say high.
High. Okay.
High from the past 20 years.
Yeah.
Sure.
High from the, for the kind of where they've been, but you're seeing different behavior as far as what sellers and buyers are doing, correct?
Yeah. I mean, I think it's really important to talk about like the difference of the markets, even though the macro looks the same. If that makes sense. So interest rates are pretty close to similar to where we were last summer. Maybe we're a little bit elevated in comparison right now, but overall, for the most part, it's a different mindset on an individual level. So last summer, you had a lot of people that didn't want to sell. There weren't as many homes on the market. And there was this attitude of, I can't move anywhere. I can't go anywhere because I have a low interest rate. So when people were purchasing, they were still kind of getting a little bit in a bidding war because there were fewer houses, where we're starting to see sellers like change their priorities, focus on maybe it's moving for their family or moving for jobs, or they're just transitioning. They're getting over that and they're realizing that other priorities are more important. So we've got more houses on the market now. I mean, even since February, we have more houses on the market, and now they're starting to sit, but they're still not sitting for 6-month period, which is like a buyer's market. We're at a 45-day window on average. For houses.
So let's just break that. So most people, when you hear the term like buyers or sellers market, how do people determine that?
So a buyer's market is like that houses have been sitting for 6 months.
Okay.
Seller's market is not.
Okay.
So we're only at 45 days, but everybody in the media is saying it's like a buyer's market right now.
Right. Okay. And do you think they're doing that just because they're trying to get, I don't know, people to hone in on it, or you think they're just
who knows
something
what
to talk
the
about?
news is doing what they're doing.
Right.
But I think what's important to realize is that it's pretty neutral for the most part. Like you're still asking for full price value on the houses that are being offered. But what you are seeing is seller concessions now. So what that means is on VA, FHA, and conventional loans, you can ask up to 6% of seller concessions, which can go towards the closing cost. So if the purchase price is $300,000, that's $18,000 that you can negotiate.
Okay.
That can be used for title, for broker fees, for an interest rate or escrows. So it's a really nice thing to have. And if for all of those costs get covered, then, you can even use it to like help buy down the rate to have it lower. It's a way better use of the dollar than you just asking for $18,000 off of the overall price.
That's exactly what I was thinking. If you just try to get a lower price, that's just going to get rolled into your mortgage.
Yeah.
Which might save you over 30 years.
Not that much.
$12 a month or something.
Yeah, something like that.
Whereas if you can use that, what you call it, seller concessions?
Seller concessions.
So if you use seller concessions, then you can use it for some real cost right in the beginning.
Yes. And so if you can help use it to help buy down the interest rate, you can have a much better monthly savings than that 18K just rolling off on
and we've talked about
value.
this before too. And like, I know you have actual statistics here, but like most people, I'm guessing, do a 30-year mortgage.
Yeah.
And they probably assume that they're going to be there, right, for the 30 years when they make the decision. Or I don't know, some of them do, some of them don't.
Yeah.
But how many people actually make it the 30 years?
Oh, I think it's like less than 13%.
Okay.
Roughly. Yeah. So basically what we say is like most people refinance within a 10-year period. I think the statistics around like 87%. Roughly. Don't quote me on that. But overall, like for the most part, the idea that you're going to stay in that interest rate for the life of the loan is not very realistic.
Or just stay in the home. Like how often do people normally move?
Well, I mean, I think that's a statistic I don't know necessarily.
It's okay. 65% of all statistics are made up on the spot anyways.
So you want me to be one of those now?
I'm just kidding. But I'm just saying like 30 years is a long period of time.
It is.
It's a long period of time. Like most people, like, children grow up or like people's, their situation changes. So I think most, buyers go into it with the assumption that I'm going to stay here, but just life happens and changes happen and, people move or an opportunity comes along or whatever.
It's more common than not for people to move in a 30-year period.
I've heard that things that I've read is like people move like on average every 7 years.
Yeah, that's probably fair.
But one of the other things I've been curious to ask you from our previous conversation is that I didn't get to ask you the first time is I want to know what your thoughts are on with buyers and sellers with so many tools that are out there where things like Zillow and different apps and different things where people go online and they see, hey, Zillow says my house is worth this.
Mm-hmm.
And I'm not selling it. Zillow says it's worth this. So that must be what the house is worth. Like I'm not budging off of this price.
Yeah.
And so that's from a seller perspective. And then the buyer perspective would be, okay, I can't afford this house. They're not going to come down off the house. I feel like buyers and sellers get anchored to that price, right? So that anchoring bias comes in, and that's where, individuals, buyers and sellers are basing their thought processes off of that number.
Well, I think that's where actually real estate agents come in on both sides of the table is to pull comparisons and look at the overall value and the appraised value for the house and the area, square footage, the amount of rooms for it to actually be a valid number or not. Like Zillow's not really.
Well, where does their information come from? I mean, like I'm coming from like I have no knowledge on this. Yeah,
I mean, it comes from a computer, like the database. It's all computer generated, and I mean, for the most part, you can kind of think of Zillow or Redfin as like a starting place of like, oh, I think this is roughly what it is, but at the end of the day, it doesn't catch all the details that you're going to get, whether from an in-person appraisal or from like actual deep dive into the comps for that house specifically, right? Because they have to do a level of square footage inventory, bedrooms, bathrooms. If that's changed and the computer doesn't have that information, it's just inaccurate, if that makes sense.
I mean, it's like a starting point.
It's a starting point.
Because that's why you still have to have somebody come out and appraise your house.
Yeah.
Zillow, Redfin, they don't know if you redid the bathroom, redid the kitchen.
Yeah. Or added or took away.
Yeah. Or like if it's not in as good shape as they thought it was going to be, like all of those things.
All the things. And so I think it's really important when you're talking to your real estate agent to, pull comps within a mile that have sold in the past 6 months that are at the same square footage and the same beds to baths for that space to really have an understanding of where it's going to lie, if that makes sense.
Yeah.
But too, like we are seeing a tiny bit of the market coming down. I think it's like 4%. And like overall, there only is 4% is like shifting down, but everyone else is staying pretty consistent right now. So it's not like we're going to see this massive downfall in the market.
So prices aren't necessarily going up, but they're staying flat. Is that what
it just varies on the area?
Yeah, right. Oh,
it's really just kind of based on the city,
specific to the industry or the area that you're in.
For sure. I've got some areas that are going up. I've got some areas that are neutral, and then there's some areas that are like tiny bit coming down.
What about all the like development that's going on for, I don't know, properties that aren't going to be owned, but they're all rented?
Yeah, so that's kind of interesting. I think I had like brought this up about like last summer on another like Instagram thing, but there is this movement of developers that are building not to sell but to rent, and it's already such a commonality. Like those properties are already built all over the country. You're seeing a huge influx in Phoenix of that, in Atlanta, like where, and I even saw it in Boise the other day, where these properties are for rent and not to buy.
Are they apartment? Are they home? Are they
homes, single family
homes?
So it's the strategies are changing. The landscape is changing on a micro level. Like, so we're at a point now where just because things look similar from a distance perspective, last summer, the behaviors are changing.
Right. I find that like, interesting when we think about interest rates and all that, and they look at like the CPI, the consumer price index, and you look at where inflation is and where it isn't.
Mm-hmm.
And one of the places that it's still like sticky high is on rent.
Yeah.
And so, I mean, this goes with what you're saying is when you have developers that are building these things out to be rented. Well, one of the issues is a lot of these are new. So the rent's going to be high, right? Because they're trying to get their money back and all those kind of things. But it also impacts somebody's ability to save to be able to eventually own a house.
Yeah.
So, but do you think there's some, I don't know, some part of the market that's like, I'm never going to own a place. Like I'm just going to rent forever. Like, and they're just okay with it, or?
Yeah, I think the market is changing. I think that buying is going to be a luxury. I don't think it's going to be something that is for everyone.
Right.
And I think whether it's a personal decision or a financial decision, times are changing. And so it used to be something that you do to take your first step in investing. And now, like, I mean, just even if I buy I'm renting a house right now. If I buy the house that I'm renting, it's because I just moved, FYI. But if I bought that house that I rented, I would be paying about a 50% markup on what I'm paying right now just for that mortgage versus in rent. And so you have to really evaluate whether the numbers not only make sense, but also if it's a part of the long-term plan
goal
for you.
Yeah, right.
Yeah.
Long-term goals.
Mm-hmm.
Yeah, I just think it's, I mean, you bring that, I mean, I think that's just the interesting point of like, it could end up being a luxury for a lot of people.
Yeah.
When it was, you hear it talked about as the American dream to own your own place and things like that. But there's also businesses where, if you look years ago, like obviously I do a lot of stuff in the stock market, and that was a business that 40 years ago was really hard for somebody to get into. Like, I mean, like a regular investor, you had to contact a broker, you had to pay commissions, you had to do like, there was all these kind of levels you had to work through to actually make that happen.
Mm-hmm.
And then today, as long as you have a cell phone and you can download an app, you can trade stocks and you could have $10 in your account.
Yes.
That wasn't the case years ago. Whereas it seems like real estate is now maybe more challenging in this environment for people to get into. Things like stocks and crypto and those kind of things are easier. Gambling, there's different markets that are easier for people to get into now.
It's a easier game to get into stocks than it is to get into real estate now.
Yeah.
It's a lot harder buy-in for sure.
Yeah.
And the monthly average cost is more expensive as well. So you definitely need to know your intent, be comfortable with all those numbers.
Yeah.
I think in some ways, like the interest rates being higher are at a point where it makes you be more conservative in your monthly budget spending of how you're spending money. So you can't really overbuy, if that makes sense.
Yeah.
So I think from that perspective, that's not a bad idea. But from a perspective of how your dollar is getting used every month, you got to make sure that it makes the most sense. In it.
I've had some younger people approach me about thinking about buying real estate.
Mm-hmm.
And the thing that they both, or I guess three of them said is they think that interest rates will be lower in a year, which we don't know. I mean, obviously we don't know if they will or will not, but their thing is if I buy now, and they drop interest rates, they think the price of the house would go up, and they're like trying to, and obviously timing the market is always, you know, not recommended. And my question to them was like, well, how long do you plan on staying in it? Like I go back to our first conversation, which was like, how long do you plan on staying in this? I don't think buying a piece of real estate because you think interest rates are going to drop and then you could sell it or whatever. Like, I don't think the market necessarily, if interest rates go down, I don't necessarily think that that means that real estate prices will go up.
Yeah. I mean, it really depends on the amount of buyers in the market at the time.
Right.
So if the rates go down, you will have an influx of buyers in the market, which in turn, what happens is how appraisals are done is that for every 3 houses that are sold in the area within a 6-month period, at that square footage, that rooms and baths in a within 1 mile of the home, they are the new comp.
Okay.
For that house. So you just need 3. If that makes sense.
Yeah.
So you have 3 sold, 6 sold, 9 sold in that area. Like, you are setting a new trend. So in turn, it will pick up if you are getting multiple buyers in the same neighborhood and multiple transactions, if that makes sense. Yeah. But at the same time, like, you shouldn't be thinking about what your monthly payment will be once the market gets better so that you can get lower interest rates. And that's what you're building your budget on. Right. You need to be super solid and comfortable with if it stays the same. If it stays the same.
Yeah. Well, and a lot of this, I mean, it depends on the neighborhood. It depends on like, the geography, where you're at. I mean, all these things, it's whether we're talking about real estate or we're talking about like, it's so super specific to like what the individual thing is.
Yeah. And at the end of the day, I tell people, if you can afford to buy right now and it makes sense and you're planning to stay in the house for, 5 years, do it. Like, there's a chance you're going to be able to have a cost savings.
Right.
But at the end of the day, like, real estate is still a great way to build equity and to have an investment, have something to add to your portfolio.
So you talked about seeing different changes from last summer to this summer. Are you seeing on the residential side, do you see any differences like in commercial?
I mean, I think that people are the mindset, like, whether it was last year or the year before, where there's a big push to get back to the office, where it was like an emotional conversation that companies were having with employees to try to kind of convince them that this is what was best for the company. I mean, it's best for their spreadsheet at the end of the day. And so they're losing money on all of these commercial properties. So there was a big push to get them back because they were just throwing money away on these buildings. But I think people have kind of come to learn to accept that if they want to work at this company, they're going to have to be in office. If they don't want to be at that company, they have to make different decisions. So I think that the pushback is settling, and you're seeing people just having to make personal decisions about what's best for them and their family,
Yeah, for sure. I don't think we're going to see like, everybody was expecting this year to be like really bad for commercial real estate and all that, but I don't think we're seeing it as
I don't think it's as bad. I think it's kind of actually coming back a little bit. Yeah. I think people are starting to realize the purpose of collaboration and being in person. Yeah. And I think at the end of the day, it's still a business model that makes money. Yeah. And especially in the real estate world, like, commercial is a place to be.
So how's, you've transitioned a little bit. Like we talked about like you doing your own thing, you kind of building your own practice up and kind of my favorite part of our second episode is when we started laughing when we talked about you working for somebody else again. Like we both started laughing about that's still like my favorite part of that episode because it was just such a pure, like, I don't know, just just a moment of like, man, it's so great to be able to control my own destiny,
Yeah.
But now you're really working with a lot of other people.
Yeah.
And like training people.
Yeah.
And helping them do those things. How has that gone? How is it trying to train somebody to do what you've done?
I mean, I think the model that we have set up is a little bit different because they still, like, even though we all work together and we're a group, we're all still individuals. So that level of like hierarchy that you have to be in your butt in your seat at this time.
Yeah.
It doesn't exist. You
Right.
know, it's just like, you are your own success and your own failure. And I want to help you be your own success in that. And so, like, as long as you execute the things that we tell you about, you will be successful, but it's still your responsibility. It's so much
it's
more
still
of
up
like,
to you.
but it's so much more of a coaching position than it is of like a managerial expectation.
So more like a mentor
Yeah.
type role.
Yeah. And it's really nice from that perspective because, you can people see them thrive or you can see them like
Not.
not.
Yeah.
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 I mean, it's up to you. Like at the end of the
it's
day.
one of those things that's, you can open doors for people, but you
Yeah.
can't make them walk through them.
You absolutely can't.
And so sometimes that's painful, but sometimes it can be very rewarding too.
Yes.
Like when you see somebody succeed and you see them kind of start to take off and they really just needed somebody to believe in them for a little bit.
Yeah.
And then being able to like play that role can be very rewarding.
Well, it's fun because we have built like marketing systems in place. And so when you see, like in my case, like a loan officer take it and apply it. I got a text message this weekend, actually, where she was just talking about 3 new clients that she just onboarded and she just got started with us and how much the marketing playbook is like really working for her and the systems that we built. And it's really fun to see stuff like that because it's like, yeah, like as long as you follow the recipe, it's great,
Yeah. Well, it's such a different, it's not different, but it's just for you were focused on yourself and building your thing up. And then you went from that to like mentor pretty quick. I mean, that's like,
yeah.
I mean, you did go to that pretty quick.
Yeah. I don't think I was planning on it happening as fast as it did, but it's just been a need that needed to be filled and it just accidentally fell into my lap. And so, yeah, like we are at a point where we're building systems like playbooks for people to use, kind of like a cookbook. Like someone gives you a recipe, here's the recipe, but you still got to cook it. Right. So they still got to cook the meal. And if they take any versions of it, like it's either great or it's not successful. But then there's other levels where like we're, kind of in person cooking with them, I guess. And so that's been a new part of it. And it's been a humbling experience for myself because I'm looking back and I'm like, am I really teaching right now? Like, is this real? Am I really there? Like, is this full circle? Like, it's, it's just kind of like one of those like positive, like moments where it's like, I do know what I'm talking
I'm on
about.
the right track.
Yeah. Like, and so it's weird, but it's, super humbling and I'm super grateful for it. And I'm excited for all the people that I get to work with. And
a little out of body. You're like, did I just say those things? Like, is that really, I know my stuff this well, this good, I mean, it's, it is, but it's also like a natural, like it's been very natural. It's not something that a lot of times when I'm talking to people about this, and you talk about mentoring or whatever, helping other people out, nobody ever really says like that was their goal. Like it always seems to be like it was just this natural progression of things. Things kind of fell into place. And then you have to, you like seeing other people succeed and you like, helping people.
Yeah. My daughter is 5 and she just learned how to fully ride her bike this summer. So she was like struggling with like balancing and like staying straight.
Right.
And then she kind of got it one day and we were at this water, what are the water splash pad things, And so another little boy that was 5 was there who hadn't learned any of riding a bike yet, asked if he could ride. So like at first I kind of helped him a little bit, but then I was like, all right, we'll take a break. And then the next thing you know, she was teaching him how to ride the bike. And it was awesome. Like she literally had to put words out of her mouth and teach him. And then by the time it was over, he was riding like the bike. And so we were talking to her about it. And it was kind of one of those, like, a skill when you can tell someone else how to do it with success.
Yeah.
And that's kind of exactly what it is. It's like you take a step back and you're like, wow, like I do know how to do this. And now you know how to do this. But I think teaching's that great element for that.
It is. And it is definitely, you can't, I mean, I do when I'm teaching, I'll learn something and I'm like, man, but can I teach this? Because it is a different, like, can I explain it in a way where somebody could take it and then actually be able to use it later on? Like, it's like, I know, like, and there's certain things. It's like, I know this, but man, do I know it well enough that I could actually teach it?
You have to know it, and you have to know it so well that you can think outside of the box with it.
Right. And you can see where somebody's making the mistake.
Exactly. So you've got to have done it enough times yourself.
Right.
So I think that's also something great about our branch is that we are all practitioners. We are not just teachers and managers.
Right.
So we all have our current clientele as well.
Yeah.
And so when the market is changing, we are changing with the market. And so if the marketing plans change, we're the first to adapt before we roll it out. We make sure it's successful before anyone else touches it, just because we want to make sure that what we're giving is going to be helpful. And so, that's where I think what happens with teaching sometimes or managing is like people step back and they get out of the flow with the clientele. And so stuff that was happening last summer is not happening this summer. And, even in February. And so you're constantly having to shift strategy all the time.
The market it's like a river, like it's constantly flowing, right? So there's things that it's kind of the same, but it's not necessarily the same. I mean, it's like with me and stock market investing. I mean, it's never the same. It might rhyme, but it's never exactly the same.
Yeah. You have to have your muscles developed.
Correct.
You have to be self-aware and you have to have like your goggles on and paying attention to everything around you to be successful. And so I think that's the great part about it is as I'm mentoring, I'm experiencing it like on my own. So I have feedback that is actually helpful.
And you're still writing loans and stuff as well, right?
Oh, absolutely. Yeah.
So you have to have your systems in place.
Yeah.
And they have to be locked in because you don't have as much time as you used to because you're doing your stuff, but you're also mentoring people. So your habits, your time management, all of that stuff has to be like synced in, I'm guessing.
Yeah. So so I've got my clientele and then we are executing like systems for the branch and marketing for the branch and sales for the branch. And then also I'm mentoring an individual group as well on top of that on an individual basis. And then, we have some exciting things to come in the future to expand on those other systems. And so there is a lot going on. But I think for me, what I've come to learn is in my ADD brain is that I am best when I have a calendar and I write it down, whether it's that I'm being a mom for those 4 hours and I'm like, this is my Tenley time and it's literally on my calendar, whether or working out or eating. It gives me this sense of peace of like, okay, I'm not spending too much time on X, Y, and Z activities. But then when I am in that activity, I can be fully present for those. So do
you use like a physical, like do you write down in a calendar or do you use an electronic calendar?
I used to use a physical calendar probably up until my mid to late 20s. And now I've switched over to Outlook because other people have like...
because they can put stuff on your calendar?
Yeah. And like there's team meetings and different things. It's hard to track all of that.
I'm still old. I'm old, Ashley. I still use I write down. I literally write it down on a calendar still.
I mean, I think that's wonderful and tactile. And you also work for yourself, by yourself. I'm working along with so many other individuals right now that like it's nice to have a bell go off when I'm supposed to be meeting somebody.
Oh yeah, like 15 minutes before. Yeah. I do that. I use the like electronic calendar for university, but I keep one for like everything in one spot. The thing I like about writing down in a calendar, like or electronic calendar, whatever, physical calendar, whatever. The thing I like about it is then it stops bouncing around in my brain after I write it down.
Well, yes. I mean, I literally have my time with my daughter after school, like blocked off for the rest of the evening till bedtime. So my like loan officer assistant knows when I'm with her so that like I can't take calls during that time. And I think it's helpful so that she knows it, I know it, and we'll just take care of it after, if that makes sense. Yeah. And then when I'm with Tenley, I don't have to worry about it.
So 3M, the company 3M is who makes Post-it notes, their number one product.
Yeah.
I pretty much keep them in business, I think. So like I've done this for so long where I take a Post-it note. I usually draw a line down the middle and then draw a line horizontal on it. And one category, like one corner is for like Write Our Equity stuff. One corner is for university stuff. And then one is for like personal things I need to get done. And then the other section is like people I need to call that day.
Yeah.
And so I'll just basically like every day I will make a note where I just like, it's been one of the best ways of an easy way of like, okay, what are the things I need to get done today?
I mean, I think that that's like a very fair thing. I just keep mine in a notebook.
I just think that everybody that I know that's productive, we might not have the same system, but there is a system.
You have to.
Yeah.
You have to. There's just too much to do.
Well, there's a lot of individuals who just float and they go into the day and they're like, I don't know what I'm going to work on today. Like, and it's why like all these podcasts I do, I always say, don't mistake activity for achievement, because there's so many people who just float. They do a lot of like, what do you do? I'm busy, but they don't actually accomplish anything because they've never had a list to know like, what are they actually trying to do?
Yeah. I mean, I think it goes back to the idea of like, whether it's brick by brick, like you've got to move a piece of the puzzle.
Yeah. You got to
once a day.
Some progress.
And whether it's on 8 different subjects, you've got to move something. And if you're not moving anything, then what are you doing?
Right. And if you're not measuring it, then you don't know.
Yeah.
You know,
I think it's nice. I think that's the part is like one of my favorite tactile things was being able to like cross it off. Like, say it's been done.
Your brain.
Yeah. I'm like, it's officially over.
I know Ashley well enough to know that she probably gets a lot of satisfaction out of it, actually just crossing something off the list.
Yeah. So my list doesn't exist on my phone.
Right.
My list is hard paper, but the schedule.
Right. Okay.
That is,
that's a good distinction.
Yeah, for sure.
That's a good distinction.
Because it was not satisfying enough, and also there's something about registering, writing it down and remembering when you do it versus everything being digital.
Yeah. I'm going to be really old now, but like talking about like scratching it off the list, like you don't get that with like, if you have it electronic, it's kind of like the young kids will not understand how satisfying it was when we had flip phones and you could actually slam your phone, you can't really, you really don't get that satisfaction anymore.
I haven't thought about that in so long, but you know what? It was actually very gratifying.
Yeah.
I could just finger.
Yeah, exactly. Now it's like, $1,000 or whatever if you, slam your phone too hard. So
yeah. I actually just bought those like little balls to like squish just to like have something to be able to carry around.
Yeah, for sure. You got to figure out something. You got to have something.
Or like, but just writing in a journal, I think is also like very therapeutic to be able to versus like writing a note or using like your voice notes on your phone. It's something about getting it physically out that makes it go away.
Yeah. You have to find like everybody has to find their system that's like to help de-stress, declutter, those kind of things. Okay. So going to move on to something new.
Okay.
Which is you have started investing in stocks.
Yes.
So this is Ashley helped me buy commercial property. And so this is me paying her, like, this is all right. So we got to start investing in stocks at some point.
Yeah. So, I mean, I think, curiosity kills the cat. I think that's how we started our friendship was I was curious about how to invest.
Right.
And I had no concept of how to get started, let alone how to open a bank account for it.
Yeah.
So it was, like, okay, you're an investor and a professor, so you like to teach. Will you teach me how to get started on a very childish, basic level?
So what's been like for you going from real estate to stocks? What's kind of just the high level stuff that you see as the difference?
I mean, well, it's a different beast. So you can't assume that one is the same.
Right.
And yeah, sure, they're numbers at the end of the day, but they operate completely differently and it's a different game. And then even in stocks, I'm learning that there's like 4 games, like just in stocks. Like, so you've got like day trading and long-term trading and like shorts and like all this stuff.
Right. All the different
these
ways.
things,
Yeah.
indexes and individual stocks. And I think it's really important to not invest in a lot until you understand what you're looking at.
Yeah.
If that makes sense.
That is absolutely a fantastic point, because there's so many different ways that people invest, day trade, whatever, whether they're using technical analysis, fundamental analysis, whatever it is. And doesn't mean you have to do that, but understanding that there's different ways that others are doing this lets you know, like, okay, like there's different, depending on how I want to do is to figure out what kind of investor you want to be, you have to understand how all the other people are doing it.
Yeah. And I think for me, like I would always hear you should invest in an ETF or index, whatever.
Right.
And I think I have no concept of what those were. So it was a really great starting point to just be like, let's just learn what a stock is.
Right.
Let's just look at one company at a time and learn about one company. Then let's expand it to 5. Then let's look at 10, and we watched it for a while. Right.
Yeah.
So I started to learn trends and how to look back at 5-year trends and 1-year trends in a month, and which really helped me understand also just like the 10-year treasury, which is like what the mortgage market is based off of. So it was a good, like, let's just have like the ground setting and like build a good, strong foundation. And now I think I just only call you when I'm like, hey, I'm thinking about trading this. This is where it's at. This is my goal. What are your thoughts?
Right.
You know? And so it's been nice progress on my part. I'm no level of like an expert in any of it. I'm probably still a beginner, maybe intermediate, but it's fine for me.
Yeah. I mean, but it's also like you started the journey. My favorite thing is you started investing for your daughter.
Yeah.
Who's 5. We'll just put that, but again, it's like you understand the concept of compound interest.
Yeah.
And that, like, if you start for somebody when they're younger, they're going to have more years for that to happen for them. But also, and something I've mentioned a lot on my podcast when I've been alone, was when you look at academic research, and it shows that women are better investors than men on a whole. And one of the big reasons for that is patience. And one of the things that, has been enjoyable for me watching you is that you have a lot of patience when it comes to the market, but also when the market isn't doing well, like this past April.
Yeah.
Like you're pretty stone cold. You don't get freaked out. Like you really don't.
Yeah.
You're like, hey, I want to, like, what should we buy? Like, what should I invest in? And you have companies that you are watching, and you notice, like, hey, I want to be a part of this company. I want to be, a shareholder of this company. And so you're patient, you know which companies you want to be invested in. And then when the market isn't doing so well, you don't get freaked out.
Yeah, I think that has a lot to do with, the way that my family raised was like, long-term investments was something we learned at a very early age, and so we were very blessed to learn that you don't take money out when the market is bad because you're coming from a place of fear. You just forget it exists, and in time it comes back. So I think that was just built into us at an early age. And so I see when the market is down, I see it as a time for sale. And that's when you buy, and then you hold. And I think something that I'm starting to play with now is like, we're having talks where I'm like, I'm going to sell. And you're like, no, just hold. But I'm like, but then I could take that money and I can invest it in other places. So now I'm starting to like break outside the box a little bit more, if that makes sense.
Yeah, because it's a comfort level.
Yeah. And so I think there's a period of time where it was like, okay, I got to watch it go up and down a couple of times.
Right.
And now I'm to a point where I'm like, all right, now let's just make the right moves at the right time.
And you're also like, you've tracked the companies that you're interested in for long enough.
Yeah.
That you have a familiarity with, like, how they trade, and you just know the companies well enough. And that if you're invested in them and the market turns, you're not going to panic on those companies. You're actually going to buy more. Like, you know what I mean? So you're in companies that you're willing to hold. Yeah. So you're willing to stay invested.
But mind you, I knew nothing. I didn't even know. I didn't even know the company's like symbols. So
Yeah.
it wasn't like I was like always invested in these companies. I've
Right.
just learned about
No, I know.
them.
Yeah,
I just need to make that very clear.
Yeah, but it does show that like you can start with a low knowledge base.
No knowledge base. Let's just no knowledge.
Right,
no
so
knowledge.
No knowledge base, and slowly start. But the other thing too is your expectations were good, and you did not expect to be an expert overnight.
Yes.
That's the thing is like there's so many. The example I use in my classes is that investing in stocks is one of the only places where people will watch one video or whatever and be like, I'm an expert. Whereas I don't go to Barnes and Nobles, read one chapter on heart surgery, and then be like, hey, Ashley, I just read this one chapter on heart surgery. I'm here. You're having some heart trouble. I think I could probably do it. You know,
but it happens in real estate all the time.
Sure. Like, I agree.
It happens in real estate all the time. And I think you have to separate. I think the psychology is separating it as, are you doing this for money for a living, or is this in bonus of whatever you're doing on top of it? And so if you get to the root of whatever that person is doing, most of the time they're trying to do it for living. And so that is where you're going to find the separation. For me, it is, I am a mortgage broker. Right. I am not an investor in stocks. That is not my career path. So as I'm learning about it, I have time and patience to learn it versus me trying to be a day trader and do that. So I think that there's a big separation. If you're trying to do it for financial, like go work.
Keep your lights on this month.
Yeah. Like go work for somebody else, like Charles Schwab or Fidelity, or, sit for the test, do it that way. Don't try to day trade and just play all the candlestick up and down. And,
wow, look at
I've learned, I've learned some things. It's at the end of the day, you're watching, it's BS, and so you have to really know the business and what's going on with it to know. And obviously there's a lot more to it than that. But at the same time, it's high risk, low reward. And I think that there's a lot of there's some groups that I've been in for like women in investing where I hear their stories of like, I had 10,000, I got it to 960,000, and then I lost it all on a big trade. And so it's like, why would you risk that level of?
Well, there's a big difference between taking on risk and being reckless.
Yeah, but it's common, I think, in investing. And so that's where you can get in trouble.
Any business where, somebody can make a lot of money, whether it's investing or real estate or whatever. Yeah. There's going to be a lot of systems, where, people want to tell you the system that got them where they are or what. I mean, there's a lot of bad right turns that you can take. And it comes back to having good habits, discipline, and leaving it alone for a little bit.
Understanding the bigger picture in any of it is going to help you be successful, because when you see something like this rug, for instance, if you can see the whole rug and then a part of it gets burned and you need to replace it with new, if you don't understand the pattern to the rest of it, you don't know what to replace it with, and you don't know how to fix it, and you don't know what comes next in that pattern. You have to have enough knowledge to know what you're doing and what goes where. And there's 25 different things that go into it, whether it's the technique or the design or the color weaving. And so it's irrational to assume that it's just linear and it's all in one direction, just constant steps. The map doesn't work like that. It's usually like more of a constellation of stars, and you just don't know which one to go to.
And especially when it comes to somebody's portfolio and how they design it. I mean, one of the big conversations I have with a lot of people is like, not every stock that you invest in has to have the same goal. Yes. This one could pay a dividend and I want the income off of it. This one I think is going to have high growth. And so I think like you said, you have to have your knowledge base to a certain area where you can actually just kind of understand the differences and be able to have a real conversation. And as you say, see the whole rug or the whole portfolio and how you're designing it.
I mean, I think this is controversial in the getting started world, because they all say to do ETFs and index funds and mutual funds in the beginning. But I also think that they're actually kind of complicated, because there's so many companies in each one of those. And so what's been nice, the way that you've taught me is like in the individual stocks, which they all say stay away from individual stocks, is like I'm learning about each company and the differences of each company. And then I'm learning that with this company, I've seen this trend. So I'm like, okay, I like buying it around X amount of dollars. I like selling it around X amount of dollars. And I like taking that and then putting it in something new, where there's other ones that I like just holding through the roller coaster of all of it, you know? And so I think it's one of those things that is like, as long as it has a good dividend and like you're not getting in high and you're buying it like either neutral or low, it's a good thing to start. And you buy in small pieces. Like you don't buy a big jumbo bag. You buy like a couple of pieces of candy at one time. And then you just kind of go from there. And I think that's been really valuable advice that you've taught.
Well, and then also, and the reason the ETFs, the mutual funds does is because that's what most people's retirement accounts are.
Yeah.
I mean, most people, when they join a company or whatever, they get access to a retirement account. Like they're not giving access to like the whole investment world. They're only given access to the certain investments that they pick for them. And so it does get confusing. I know. It does get confusing for them though, because you're right. Like you see a symbol for a mutual fund and whatever it is, but when you see that symbol, you don't understand what it is.
No concept.
And most people have no idea. They don't have any clue what's in it.
Isn't someone kind of like trading those constantly? Like whatever that fund is?
It depends. I mean, it depends on the fund. It depends on the company. If it's a ETF that's just tracking an index, the S&P 500 is probably the most common. I mean, they do periodically change the investments inside of that.
Yeah.
So, I mean, there's still, but for the most part, but that's much different than a mutual fund that's actively traded where there's something actually that you can go look for. If you have mutual funds, you can go look at the turnover rate, which is going to be how often do the investments inside of that fund turn over.
Okay.
And so that if it has a higher turnover rate, that means that whoever's managing that fund is going to be buying and selling securities quite often.
Where could you find that, like on the sheet? Like, is that on the profile or?
It'll be on the fact sheet, but if you go to the one that most people use is probably Yahoo Finance, so that's going to be finance.yahoo.com. You can type in the symbol to your mutual fund or whatever. It'll bring up kind of the top 10 holdings. It'll give you some stuff. It should have a link to their website, and then you can find the turnover ratio on their fact sheet.
So I'm not going to be able to find it if I click on the mutual fund in my Fidelity account to be able to find the numbers there.
No, they're going to make you hunt for it.
Okay. So see that's something that like you have time to like read the reports.
Right. Yeah.
Like I don't have time for their business reports. So it's like for me, I want to know 10 facts. What I do love is the data analysis of the years, how it's been doing over the years. So I can check the dates. I can look at the whole span. I can see the cycle, and then I can see where it is today, where it was yesterday.
But are you talking about individual stocks or are you talking about mutual funds?
I'm just saying the data that I like.
Okay.
Yeah. Right. It's like I need it just to be simple.
Right.
And like the points stuff that I have to hunt for is too complicated for me.
Yeah.
You know,
I mean, but the investment world, I mean, there's some, there's a lot of people in this world, and I'm not just talking about in like stock investing or whatever, real estate. There's a lot of people in this world who make money off the ignorance of others.
Yeah, that's ridiculous. And I mean, it's like why you guys get called fiduciaries. Like
but not everybody's a fiduciary.
But in mortgage world, we are. All of us are. And so we have to do part of 2008. We have to be fiduciaries for our clients. We have to do what's right for them, or we get reported. Yeah,
but not every investment person has to be a fiduciary.
You guys get paid more to do what's right for the clients, and so it's just ridiculous because it's like the system is broken. I'm saying.
Well, I mean, but that's why
not to vent.
No, but that's why there's so many retail people that do it on their own.
Yeah.
I mean, that's why there's so many people. It's very like the nice thing about like talking to you about it is talking to somebody who came in with, I said low, you said no knowledge.
Knowledge.
But again, that's a great place because having these discussions with you, I get to see it from somebody else's perspective, like somebody's like a brand new set of eyes.
Yeah.
Which is very interesting.
I mean, I think no matter what field you're in finance, the whole point is that we should always be looking out what's best for our clientele. And sadly, it doesn't happen in any field on a regular basis. You are a unicorn when you're doing what's right for the client, and that's sad. But it should be the norm.
But if you want to play the long game, which is what, I consider it like long-term greedy.
Yeah.
I mean, if you do it, like eventually that starts to really pay off for you.
I mean, I wouldn't call it long-term greedy. I would just say if by being ethical and choosing to do the right thing, it will pay off and it will come back to you and it'll be positive. And I think something on Friday on one of my clients, I had to go to the lender and it was an overlay, which is like, just think of an overlay as like a rule on top of a federal rule. So it's just the company's rule, not like.
This is like above and beyond. This
is above and beyond what's required.
Okay.
And so I went to the lender. We were like 2 points away on a credit score for qualifying for debt to income ratio. That is not a federal rule. It was a company rule. And so asked her to go to the investor because, what happens to your mortgage is there's always a secondary market. It's not just that the bank holds it. They have to sell off the mortgage to free up money, if that makes sense. So we have investors. So I had to ask her to go to the investors to make an exception for this person because the rule was for 700 credit score. We were at 698, and we're $150 off.
Yeah.
And I think this is where it was awesome because it was life-changing for that client because I went above and beyond to be able to get that exception done, that we were able to really financially help him and put him in a way better spot. Buying houses isn't just mortgages isn't about just buying houses, but it's about using that equity in the debt that you accrue in life to be able to help you get it under control and get it in a regular, secured monthly payment and get you back financially in a better spot to live off of your monthly income. And I think that's what I love about all of it. So when you choose to do the right thing, it is a really big blessing, I think, to them and to you, just because that you literally are helping change their life for the better.
I mean, for me, I always think about having to sit across from somebody's kids or grandkids or whatever and discuss a recommendation or something that's 15 years old and me being okay, well, I thought that was the right recommendation. I'm not having to go back and try to remember something or whatever. I just feel like it makes it much easier.
Yeah. When you make good, small decisions every single day, you know that you did right by them 15 years from now.
Correct.
So I think that that's sadly not the approach that both of our industries do. But I think that if you do, there's a need for you.
That's why it's lonely at the top. There's people falling down the ladder. I mean, it's I saw that in the beginning of my career where I saw people making decisions that were short-term gain and were going to be terrible long-term.
Oh, yeah.
A lot of those people aren't in the business anymore. So,
yeah.
But
yeah,
I'm excited for us to be able to, as your journey continues, to keep talking about stocks. Your level of knowledge goes up. I think it'll be kind of interesting when we do these check-ins. I think it'll be fun.
Yeah, I'm just kind of starting to play with when to sell and then what to take that money and reinvest.
It's actually very we can talk about this on our next one, but it is one of the big challenges is when do you sell?
Yeah. I mean,
it is hard. I mean,
I think it could be, I could have been I could hold it longer and make $200 more per stock. But, I feel good about where I sold it at. I still made $600 on the stock, and that's $600 I can go and take and invest in something different. And that's a win for me.
Yeah. I actually think when to sell is harder than when to buy.
Well, yeah. But I also too think that's really important. This kind of goes for both mortgages and for stocks. But if you leave it and you don't move it, you don't really have it, if that makes sense. So like
it's just on paper.
It's on paper, but it doesn't really exist unless you utilize it.
Yeah.
So like whether that's the equity in your house that you have $400,000 that you're just sitting on, that you've gained in equity, but you didn't take it out and put it in another investment, or you like, other than plans to just stay in the house long term and it's just a wash, I guess. But it doesn't really exist unless you actually make a move with it.
Make it tangible.
And so
it's the same thing really with stocks. I always look at, if I've owned a stock for 5 years and I have a good gain in it, I look to see how much of that gain is in each year.
Yeah.
Like, did I just have a really good first year and then it hasn't done anything for the last couple of years? So I'll go in there and like, look at that, like, look at each individual holding.
Well, I think that's really important because like you lost money by keeping it in.
If it's not growing,
it's not growing on past that first year mark. So like if it's staying at the same place and it's staying stagnant, it's probably time to move it, to let that money work for you elsewhere.
And it depends on, does it pay a dividend? Does it not? Like, are you being compensated? Are you getting paid to wait? This is when talk to your financial advisor about your stuff. But yeah, I mean, it all is very, very specific to the investor.
Well, and this goes back to our conversation at the beginning. What was working for you in the beginning might not be working for you now in priorities. And so also understanding levels of interest rates and how that money affects you. A 2% interest rate on a house is great for that house, but is your overall budget healthy for the rest of your life? Your credit cards, your cars, everything else.
Well, so, I mean, even your family. Did you have one kid when you bought the house and now you have 4?
Right. And so like, just because you have a 2 now, but you've got an average of a 16% on everything else, that 16% is going to outweigh that 2%. Yeah. And so you truly have to understand your numbers and whether or not it's time to shift or not. And I think people are starting to wake up to the priorities. And I think that they're starting to see that reality come to, like, they're feeling it in their wallet on a daily basis where it's just not working anymore.
Yeah. Yeah. I mean, you have to understand your full financial picture.
Yeah.
And how everything fits together and how it goes together.
And then that comes back to the bigger picture. You truly have to understand the bigger picture and you have to know all the details in between.
And take some time to really think about where you want it to be and how you're going to get there.
And everyone should do this on their own level. But if you're not, then be willing to work with someone who does do that for you.
Yeah. But you have to be, but you also have to be a part of the process.
Yeah.
Like you have to have some buy-in. You have to have some, skin in the game, so to speak.
Well, but I think what happens is a lot of the time is you see people go to like that one burned area that doesn't take a look, and they go to someone that takes care of that one little area, but doesn't take a look of the health of the whole like product.
Yeah. Right.
And that's where you run into trouble because it's isolated. So you need to be working with people that are thinking about the whole picture and not just that thing.
And help you realize what else is, basically help you see what your blind spots are.
Yeah, absolutely. For sure. That's a whole other conversation.
Well, hey, we'll just cliffhang it there. And then that'll be where we start the next time.
Yeah.
So thank you once again for joining us. Really appreciate your time. You've been so generous with your time. So I just want to tell you thank you again. And thanks for stopping by.
Yeah, I always love being here and always have good conversations. So thank you guys for having me.
Absolutely. This podcast contains general information that may not be suitable for everyone. The information contained here should not be construed as personalized investment advice. There is no guarantee that the views and opinions expressed in this podcast will come to pass. Investing in the stock market involves gains and losses and may not be suitable for all investors. Information presented here is subject to change without notice and should not be considered as a solicitation to buy or sell any security. Right Our Equities does not offer legal or tax advice. Please consult the appropriate professional regarding your individual circumstances. Past performance is no guarantee of future results.